Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 17th, 2022. It is 3:10 p.m. Eastern Time as I'm starting the video, so hopefully I'll be able to get this one fired off before the close, you guys. It's video number 2 of the day, and all I want to do, I keep harping on the same thing. You're going to get frequent updates because again, this is so far it has been one of the most profitable trading ops in a while, and I think the potential is there for a lot more. We're on the verge here. That's why I'm doing this video, and I'm going to keep it very simple. I'm just going to go over what the my favorite picks are. As far as diversified, I'm always throwing out trade ideas, whether it's speculative stocks, sectors, commodities, bonds, you name it, Bitcoin, crypto, it doesn't matter. If it has a chart, I'll sell it. But right now, this is where I like to press it pretty hard, using leverage, and also you can pick individual stocks. I've gone over. I've given you some of my favorite semis. I've given you a whole bunch of individual stocks lately, but or you can keep it simple. And by keeping it simple, that would be, and these are my top picks, to short the NASDAQ 100. We're going to go over those charts. You can do that via QQQ. You can use leverage via QID, which is a 2-time short ETF, SQQQ, 3 times short. You know my thoughts. I've been clear lately that I think, again, it's one thing to call where you're going. So far so good. Called that first target to the button pretty much, a little intraday overshoot. But we had a bounce, a reaction off the first target, as is usually the case. And if we are heading to my second and quite likely and possibly third and fourth targets, I have a potential fourth target. I have a couple of major uptrend lines that come in right with price support. And if we're heading there, again, I already labeled just to get to my third target. Well, let's just say to get to my next target is going to be a set 27% drop off the highs. And what it's going to do, if I'm right, remember the NASDAQ 100 peaked back here in November, and it's going to wipe out, let me do this, gains all the way back to this point, really right here. It's going to wipe out 1.2 years of gains right there. Really, we'll just call it this when we broke above that level, a year, exactly a year. And that's, again, just to hit T2, which is my next target. I think we're going to do it, or I wouldn't be doing these videos. And again, it's one thing to be that precise with price targets, a whole other element of difficulty to say exactly when you're going to get there. And that's what I'm doing now. I'm going to give you my thoughts. I have been. And I think we're on that verge. We had that bear flag. We broke it last week with an impulsive red candle. Now this candle just turned red. That's why I'm doing the video. I was waiting to see the close from last Friday to get taken out. Now today, the day is not over. The week isn't over until tomorrow. But as of now, so far, it's looking good because we have, again, this candle won't be finalized until Friday at 4 p.m. This is the weekly chart we're looking at. But so far, we're taking that out. So that's follow through again. What you want to see, there's no guarantees, but it's what you want to see with a bear flag. You want to see an impulsive move down, flagpole, followed by a level consolidation that takes, or a little bounce that takes the form of a flag, followed by a breakdown, and ideally impulsive. And so that's it. And if we get that and we can follow through and we can take out those lows, boom, it should open the door for the move down there. And that's what I'm getting at. Because of that, if it plays out as such as a flag normally does, it should be a pretty quick swoon down, faster than most expect or think can happen right now. So we'll see. And again, those are your trade ideas. You can go with QQQ. You can short that. You can buy QID, which is a 2-time leverage inverse. Either you could do that non-cash, a non-margin account, such as an IRA or just a regular account. Don't be careful with your IRAs and 401ks. If you don't know what you're doing and you're new to this, maybe just go to cash in those and cut your teeth trading in a trading account with money that you can afford to lose. Again, I can't sit here and tell you all the pitfalls of trading and investing, but there it is. And QID, just like the QQQ in reverse, we're still on the weekly chart. That's what it looks like there, and that's a big divergent low. And therefore, you could have a nice gain. I'm not giving you targets here because you can just correlate those targets with those on QQQ. There's so many different ETFs, so many variations, leverage, non-leverage, inverse, 200%, 300%. I can't possibly give targets on all. I do on some. But as I said, if you use the juice right now, and I'm correct, meaning the leverage, and it is a quick swoon up, then here, you can look at it this way. Here's a flag on SQQQ, the 3-time leverage, and that was good for 68%. So therefore, you would take, here's how you do it. You go like this, roughly, if that's your flagpole right there, and there's the bottom of the flag right there last week. Take us up to there, and from where we're at today, that would be about 44% in your pocket, which is, considerably more than what it would be if you were just one-time leverage short the NASDAQ 100. Okay, so let's move on. I'm just firing off my top picks. What I think, and it's simple because you have diversification. With the individual stocks, you have to worry about earnings, you have to worry about any headlines on the company, corporate malfeasance, anything that's going on. And with this, you're still diversified. You're just less diversified than the S&P 500. Okay, the next one up was IWM, small caps, looking good so far. This is the weekly chart. I've gone over this so many times. Let's not do that right now, all the developments that have happened, but let's just look at the bear flag. There's the flagpole. There's the bear flag. There's the measured move of it, which was a perfect. This was honestly one of the best shorting ops I've seen, certainly since that breakdown there, or the failure right there and move back into the trading range. In recent weeks, this was the best shorting op right here, and I pointed out the other day when IWM made a perfect back test of that range there. And so it still is. I mean, look, if you missed it, you didn't want to take it, you didn't, Randy, nah, you're too bearish. Everyone else says this is just the market adjusting to the rate hikes. Maybe, maybe not. We'll see. But you still have a relatively, it's obviously much better if you shorted it last week there, because your stop, you'd have much lower downside if you put a stop somewhat above inside the range there. You can short now, but you're a little bit in what I call no man's land. You're smack between resistance and support down there. Now, we already hit the support once. I think it'll get taken out. And again, you want to see additional selling from here now that the flag, now that IWM has broken down from the flag. And it's wanting to snap around there. There it is. My target from where we're at now, or let's just go from, this is really where I harped on the last entry for the short at 209. That would be about an 18% drop. Now, we'll talk TZA if you want to use the juice. Let's see, it's TWM is the 2-time short, if I'm not mistaken, and this is the 3-time short or bearish. And you can look at it this way. You've got a flag right there. You can use this as the flagpole right there if you want, and then add that on to the bottom of the lowest part of the flag right down there, and that's going to give you a target of roughly 55. And from where you had that objective shorting up just last week, you're talking about a 72% gain if hit. So that's how that leverage works, because it would be a pretty, well, actually no, I take that back. It could build on that. It could be above 72%, because the way it happens is that leverage, it stacks or recalculates every day at the close. That's where you can actually do even better than that 72% I just showed you. But that's that rough target right there. But again, play it safe. Just go off, even if that's what you're trading, if that is your thing. Just watch and have a price alert set for when IWM gets close to that 171 level, and I'll certainly be doing updates if and when that happens. And I'll also do updates if I'm wrong, and we just blast on through here, and that's it. And maybe we just come in for a double test of the lows and blast off the new highs. Well, we'll see. All right, IWM, QQQ, some of my top picks. You want some real juice, then you trade the VIX. Be careful here. There's several ways. You can't trade the spot VIX directly. You can either trade futures on the VIX, which this is the spot VIX index. You can trade options on those futures, and if you haven't done so, they're a little bit complicated. They don't trade. They have different expirations. It's not the third Friday every month. It's a Wednesday. I think it's I don't know, second Wednesday. You have to look it up. And options, whatever. It cuts both ways. I'm not even going to talk on that. Most traders here, I know that, or investors won't use those. So you can trade VIX, VXX, TVIX. There's a bunch of them, and I've already laid out targets here on this one for you. and we already hit the first target. We had a divergent low right there. That was when the market took its first leg down, and we hit my first target on QQQ, IWM, and SPY, right, on the weekly and daily charts there. And then you had the expected pullback, so the VIX pulled back. And so if I'm right and we're going to take out the lows, we're going to have another spike up here, and I'd say we go to at least this T3 area right there. And that would be, so again, a lot of juice. So if this is where we shorted, or this was the pullback, where was it? Right here, I think, the other day to IWM when it hit the high, and QQQ and SPY hit resistance. That'd be about 86% run. So a lot of juice in there. And this one I don't even believe is leveraged. That's one of many. Like I said, you can trade TVIX. So that one's a little more aggressive, put a little less in there. And just know this, that I've seen times where we had a huge spike in volatility and some of these VIX tracking ETNs blew up. It means they went away. And you would have lost some or possibly everything you had in there because they're ETNs. ETNs, it means exchange traded note. It's just an IOU from the issuer, in this case IPATH. They just promise to pay you back if everything goes well, but they have fine print in there. You know, this one didn't blow up. A couple did a couple years back. So I imagine it's set up a little bit more secure. Just it couldn't take such a spike in the VIX, those other ones, and they triggered a clause that just said, "Hey, guess what? You guys, we weren't properly hedged in there, and so we're not going to take the losses. We're going to pass on to the shareholders." So that's the disclaimer there for you. ETFs are much more secure. QQQ, everything I talked about, even if they're leveraged, but there's risk with everything. Just keep that in mind. And then I like the semis still, and you tend to get more bang for your buck. For example, they're down 3.42%. So I talked earlier today about my penchant to trade the NASDAQ over the Dow because of the higher beta. Beta measured against, that's volatility measured against the S&P 500 as a benchmark, just meaning that when things go well, the market's rallying, QQQ tends to go up more because it has a higher concentration of high growth companies, namely tech. And then when things go ugly, it tends to fall more. However, so then take that and strip the QQQ away from out of SPY, just mainly the tech component of the S&P 500 and other growth sectors, biotech, things like that. And now drill down within the NASDAQ or the NASDAQ 100, and you have your semiconductors as a subset of tech. Tech is the half or a little over half of the QQQ, NASDAQ 100. But within the tech sector, you have different companies. You have software companies like Microsoft. You have all kinds of companies, and you have semiconductors, and that's what this is. And therefore, they tend to be higher beta. And I know the street loves them. Big guy, I've heard it for a long time now. Shortage of semiconductors, huge demand for cars, blah blah blah. Well, demand, sentiment, all that changes on a dime, and can vanish quickly, especially if you get. Now remember, we already had an 18 or so % drop in the Nasdaq 100, 12 in the S&P 500. Double those drops, and so if we go down to where I think we're going, yeah, you're going to get a quick shift in consumer sentiment. I always, in the past, I've talked often about Pavlov and his dogs. Believe me, I was not a psychology major, but I did actually, CLEP psychology at the college level. That means if you have a proficient enough knowledge, you can take a course and they give you the credit. You don't even have to take the class. And, I find it interesting. And the reason I talk about that is this is the whole. You want to truly understand the financial markets, you have to understand mass psychology. And so the way it works, I quote Pavlov often, and the dogs ring the bell and they salivate. But the three big guys in modern behaviorism were Watson, Skinner, and Pavlov. And B.F. Skinner, he was if I remember right, I think he was a Harvard professor for years, psychologist in psychology, and he was the one that did the study with negative and positive reinforcement. He had a box for rats, and they hit the little bar and they get a treat, right? And they keep hitting the bar, they get conditioned to do that. And all of a sudden then he set up a little electroshock. So they go hit the bar, they get shocked. Well, one thing we learned from his studies is that negative reinforcement is much stronger than positive reinforcement. And so what happens is, dip buyers buy the dip, buy the dip, buy the dip, and that's positive reinforcement. And they instill those habits, but you get another big leg down, and this has already been pretty strong negative reinforcement. Um, but with the markets holding up recently, again, the view on many is it's just we're going to go maybe to a slower growth period as the market gets used to these rate hikes. The Fed will do it nice and easy, probably a quarter point here and there. Okay, so and that's great. Maybe that's going to be the scenario. But if this consolidation here, we break out of it. Remember, that's just an area of consolidation. We have another leg down. All of a sudden, they're going to be singing a different song on TV and in the media and all that. And again, psychology will turn quick. Retail sales will drop because consumer sentiment drops, and it's the wealth effect, the same wealth effect that got us to where we were and caused all these shortages. So yeah, there were some obviously supply chain disruptions with COVID, but more and more evidence has come now it's a demand problem. They overstimulated the economy, and so and also kind of factor in with that little hoarding effect. I think everybody's so afraid of everything being out of stock, they're jumping on things. I can see that in certain industries. All right. Anyways, those are fundamental ramblings, but technically speaking, let's go back to the weekly chart. This is SOXS. I did a whole video on the semis, a couple videos, and give you individual trade ideas, and here's what it looks like from a technical perspective. So I'll either be right or wrong on where I think what's going to happen fundamentally, and I'll be honest with you. I'll give you my fundamental thoughts all the time, and I could care two squats if I'm right or wrong on what I think is going to happen fundamentally. The only important thing is I'm fine with being wrong as long as I'm right on the technicals, because that's where I'm laying my bets on the charts. So, I talk about, for example, the euro, what the euro and dollar might do. But guess what? I haven't been trading the euro and dollar. I'm trading gold, and I've been bullish on gold and silver, and they're going up despite the euro dropping recently and the dollar rallying. And that's what I love to see. Yeah, it just shows overwhelming demand for the metals, and I'll get to gold in a second here in this video, but this is it. So there's the semis. There's that initial leg down, aka the flagpole right here. And the bear flag is right there. We flagged under the primary, or this uptrend line right there. This little bear flagging action right here. And that added to the top of the flag, which I moved, really top of the flag. Oh, that was a perfect backtest, just like IWM. Remember, we had these recent topping patterns here, trading ranges. This one was very well defined in SOXS, the semiconductor sector ETF, 508.65. You also had a golden shorting op there, and this is about when I was doing the video and mentioning these guys. So far, the semis have fallen about almost 10% since that backtest and objective short entry right here. But if they can do a little more work, there's a little more work to be done, take out these flags, and then the recent low 435.83. And again, the measured target that I have comes a little shy of my actual targets, and that's what I'll maintain. This is where I think the semis are going right here. This support zone runs from about 388-ish down to about 382 right there. And so, from where we back tested the other day, that's going to be a drop of about 24% in the semis, and then I did lay out for you guys. This one is a potential trade idea, SOXS. The 3-time leveraged semiconductor ETF as a potential trading op for you in lieu of the and I gave you, it must have been on the, did I give you? Yeah, there's some targets on the daily chart. I have to update this just for now. Like I said, I think position in it, let it run. We'll start hitting. What happened is the markets will all hit support, give around the same time, SPY, QQQ, NQ, yes, all that stuff. And of course, I didn't mention it. It goes without saying that you can use the futures. That's my preference in trading. I'm showing the ETFs, and I'll also round out with sector ETFs, as well, because you don't have a futures for the semiconductors. At least not I'm aware of. It's usually the major indexes. All right, so that's 3 ideas so far. The Nasdaq 100 via the Qs, NQ, or any of the leverage ETFs. Russell 2000 small caps, the VIX volatility index, SOX semiconductors, or there's various other semiconductor ETFs out there, and of course gold. I still like gold. And I like being diversified. The number one, gold's not going to go up as much as the markets drop, but we did finally get that breakout of the triangle pattern. That's it on the daily chart. I know that's a messy chart. Here's what it looks like on the weekly chart. Turn off all the lines. It's just a nice and clean symmetrical triangle pattern. Broke out last week and told you I wanted to see follow through, and I wanted to see that previous reaction high right here get taken out. Check, check. It could fail, could backtest and go, or it can fail altogether, but as of now it's a breakout, and gold and silver are moving, and that's where I certainly believe at least where part of my money is, because again, you hedge your bets and diversify, but even as a pure play it looks good. I wanted to speak, before I move on, speak to the miners real quick. I've talked about this before in the past. Typically the miners are like trading a leverage play on the metals. In other words, GDX, if gold goes up X, GDX is going to go up a factor of X. There's no set formula, but it could be 1.5, even sometimes 2 times. For example, it's up 4% today, the mining ETF. Those are the gold mining stocks, whereas GLD was up 1.42%. So there's a good example. And it's not mere coincidence. GDX took out my trend line and broke out as well this week. Look at that big green candle. That is a fat check mark right now. It's going to take a lot, and even if we back test, it's still a breakout. Only unless that back test clearly fails, that's a breakout. GDX is running right at that previous high right there. So if it can put that in the rearview mirror, this previous reaction high, and there's also price resistance there as well, another check mark for you, and it should run up here to at least 40.29 right there, then the old highs. And again, my theory for a long time has been that this is bull market consolidation and correction within a larger bull market, especially in gold. And then you also have silver and the silver mining stocks. Silver SLV is the ETF, right pushing at the downtrend line now. Right there you had positive divergence. If it pops, 23.83 first target, 26.80ish second target, and then the silver miners are poised to run as well. Now the one thing I wanted to talk on real quick in the video is I like them both, but there are periods you need to be aware of this. If we get just a complete crash type scenario, because I put those market warning crash warnings on, starting a couple months back, warning that the conditions were ripe. And again, it's not the timing of it's not like a hurricane warning where it's imminent within 2 or 3 days. This is more of a conditions that still persist. So where I'm going is, if we do see the bottom fall out of the market, I'm talking a drop of from where we're at, a quick drop of, let's say, easily 10, 15, 20%, possibly more, that could put pressure on the miners. In that case, you're probably better off holding gold. So and you can always shift out a little bit if you start to see stocks really crapping out here. Just know that at times I've seen the miners get sold down with the stock market or underperform the metal, which is unusual. As I just said a minute ago, usually gold's going to outperform the metal, but they are in fact stocks. Gold, GLD, doesn't hold a stock, it doesn't hold a company, it holds gold. GDX holds stocks, gold mining company stocks. And so as such, even though they should benefit from the price of gold, and ultimately they will, during strong sell-offs that could go down. So that's the point is, if you don't want to maybe load the boat on the miners, you might want to be diversified, spread it out. And the more conservative you are, skew more towards the actual physical metal than the miners. And that holds true with silver as well. And that's it, guys. I told you to be quick. I want to get it out before the close, so I need to stop right now, upload it. Keep in mind, when I have a market moving or a timely video that has any timely ideas or a timely analysis that may be time sensitive is what I mean by that, or in this case I want to get this one out by the close, I will post that video before it's fully rendered on YouTube. That means you're not going to see it in high definition quality right away. Wait a minute or a few minutes, refresh the screen, and then usually it will be playing back in high def at that point once YouTube finishes rendering it on their servers. But I try to get it out to you as soon as it's uploaded and playable. It takes at least a few minutes. When it first uploads, it has to render and to at least standard definition. So I just kind of want to throw that out there. Okay, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.